You know, it's always fascinating to me that the surveys and government data has far more influence on the stock market than hard news, real hard data out of corporate America. For instance, take a look at these earnings shortfalls. The last 24 hours, Winnebago, General Mills, FedEx, all these stocks are getting hammered a lot on missed earnings opportunities. And here's the thing, I get it. Maybe the maybe the RV craze during the pandemic has given way to the travel craze. You can say, okay, we understand that. But I figure people still eating Cheerios. Maybe I got that wrong. Obviously, we're getting a whole lot more packages delivered than ever before. Now, some are saying, well, FedEx, maybe they're losing share to competitors. Still, though, this business is so big. There's no way. When I looked last night, I went through the numbers. There's no way they should see the kind of declines in the U.S. business segments that they're seeing unless something is going on with the economy. Still, the market only opened slightly lower on those headlines, and then it turned around big time when we started to get economic data. And first, existing home sales, right? Annualized pace of new home sales up 0.8%, much better than a decline of 4.1% the street was expecting. But still, look where it is. I mean, this chart goes back 2 decades. So we're still near multi-decade lows when it comes to existing home sales. Of course, remember, a year ago, only 1 million homes sold. In this particular case, the $1 million homes were the only ones that really did well, up 13%. Everything below 750 was actually down. Median home selling price rose 4%. We're at $387,000. That's the 5th consecutive month of higher increases, but still well off the high. But again, the market really liked that. Then it loved the consumer confidence report. That came in at 110.7, 101 in November. And this is, by the way, much higher than Wall Street expected. You can see, here's the interesting thing, though. This is the number. You can see the downtrend. Obviously, it's still in place. Then we look more granularly at this number. We look at the present conditions along with expectations. Now, present conditions, that rose to 136.5%. 36.5. That's a pretty good number right there. Expectations. Now, that's where you saw the big jump. People feeling a little better about the future. Last month was 77. I mean, that was one of the lowest numbers ever. Still, though, down here, it's still, again, looking down a decade. That's still a very low number. Better than Wall Street expected. Stock market goes higher. Of course, the market continues to do this kind of thing. Listen, Wall Street understandably wants its cake and wants to eat it too. That's fine. And that means, you know, we get some strength there, but not strong enough for the Fed to hike rates. That's good. But it's not just the market, right? Because suddenly the Fed, which was so convinced that it was in its messaging that it was going to be higher for longer, some were actually saying we were in a new paradigm. Some were thinking that rates were going to stay higher for longer for a whole decade. But everything's turned upside down. It's on its head right now, right? Not even the hawks these days on the Fed or the FOMC believe what they're saying anymore. Yesterday, Atlanta Fed President Raphael Bostic, he acknowledged the lag effect. Remember, that's the snowball becoming a boulder, all those rate hikes, all this activity. He acknowledged it by saying they don't want to overshoot by sticking to this 2%. They don't want to wait for inflation to get to 2% before they take action because they know all the actions they've taken already making a big move. So he suggests that, well, okay, they're going to cut rates next year, but in the second half of the year, and this is where it becomes confusing. If you're concerned that we're going to overshoot, why would it take this long? Why would it take to the second half before the Fed did anything about it? And then there was a real interesting admission from my old friend, Chicago Fed President Austin Goolsbee, on Wall Street's influence in all of this.
The market's going up because they think they're going to cut. It doesn't work the other way. We should not be bullied at the Fed, in my view, by what the market wants. That's not in the mandate. The mandate is get the maximum employment and get the inflation rate down to 2%. Doesn't say anything about make the stock market happy.
By the way, right after the Fed meeting, I had a poll on all of this. I said that the Wall Street, in other words, the tail wagged the dog. 59% said, yeah, that's about what happened there. I want to bring it now from Bianco Research, their president, Jim Bianco. You know, Jim, you posed a question, and it sounds like you're describing almost a mania, to be quite frank. Can a narrative be so powerful that no one dares go against it, despite solid evidence that it might not be correct? So what's the answer there?
The answer seems to be yes, and the narrative I'm talking about is the so-called soft landing. Now, the problem with a soft landing is it doesn't have a real definition, but we mean it to mean slower growth, bring down the inflation rate, to the Fed's target of 2%, allowing the Fed to cut rates. The problem with that narrative is the third quarter was a smoking hot quarter at 5.2% growth. That is huge. The fourth quarter slowing, okay, no big deal, but it's slowing to still an above average number of 2.7% as projected by the Atlanta Fed. And you're getting numbers like existing home sales today, housing starts yesterday, beating the Christmas selling season is looking to be a little bit better than people thought. So maybe we're not having a soft landing. Maybe what we're having, to stick with the metaphor, is a no landing.
Right.
The economy is just growing. It continues to grow. And my fear is if you're hoping that the economy will moderate enough to bring down inflation, it's not going to bring down inflation. And those numbers, yeah, they're not going to be 9%, they're not going to be 8%, but they might still stay at 3, or they might stay at 3.5%. And that will be a problem for the bond market somewhere in 2024.
And that's why we played the Goolsbee slot, because I got to be honest with you, it's rare you hear a Fed official, someone actually involved in the FOMC, almost acknowledge that Wall Street has some sort of influence in all of this. Another part we see that is professional investors so overweight bonds right now. Again, everyone thinking, okay, that 5% was the peak. We're down. It won't go high. We'll just drift lower. I mean, is this another sign of too much exuberance by professional investors?
Well, I'm afraid, or I fear that it might be. And I think what's happened is professional investors, or all people, got used to zero interest rates for 15 years. And somehow we, along the way, thought that that was kind of normal, or maybe somewhere down there was normal. So when we look at 5% on the 10-year or on money market funds, or 7% on mortgages, we will walk around going, this is unsustainable. This is too high. But Charles, you and I remember what the life was like before 2009. This was like the average interest rate, and the economy was just fine, and everything moved forward. So these rates are not at punishing levels. That's what my argument is, where a lot of people think they are, and they're fearing that they're going to break things. I don't think they are.
Yeah, and of course, history shows also that the kind of aggressive rate hike cycles that we just experienced usually break something substantially before the fever is broken, so to speak. Hey, let me just alter the conversation a little bit and say congratulations. You've got a new fund out with WisdomTree. WisdomTree announces the launch of the WisdomTree Bianco Total Return Fund, WTBN. Tell us about it.
Yeah, it's a fully invested index that we are managing, the index is, and it's designed to give maximum performance for anybody that wants to invest in the bond market. So we will try to tilt it, to put our factors into place that will try and give you better performance than just owning a pure straight up index. Thank you for mentioning it.
No problem, man. I tell you what, your work speaks for itself. This is a long time coming. Congratulations. You deserve it. Everyone, take a look at it. WTBN, if you're interested in the bond market, and someone like Jim de facto really helping you with it day to day, I don't think you can miss. Jim, congratulations, my friend.
Thank you again.
All right. Folks, coming up, my takeaway.